Thursday, October 31st, 2019, Maneco 64, home of alternative economics and contrarian views. Before I start today, I'd like to reiterate that the main objective of this channel is to expose the central banks. And why is that? Well, central banking, centralized credit, monopolies are a plank of the Communist Manifesto. Central banking has nothing to do with free markets, and I think the institutions should be abolished, of course. Be as it may, I'm going to talk about the Federal Reserve yesterday and the fact that Jay Powell has actually spiked the punch bowl even more. So what's that got to do with monetary policy, a punch bowl? Well, there was a former Fed chairman, William Martin. He was chairman from 1951, chairman of the board of the Federal Reserve, to 1970. And this is what he said. The job of the Federal Reserve, he famously said, is to take away the punch bowl just as the party gets going. And he was talking in relationship to the markets, to Wall Street, right? And here we have the stock markets making new all-time highs, unemployment supposedly really low, the economy in a really good place, right? And we now have real negative interest rates all across the board, all across the yield curve, except for the 30-year, and that's just barely as well, and I'll talk about that. So I want to go through some of the stuff he said during the press conference. So let's start right now. I've got the transcript here of the press conference. I was listening to it. I did take some notes, not word by word. One thing he said at the beginning, though, and I'll read from the transcript, is this: my colleagues and I have one overreaching goal to sustain the economic expansion with a strong job market and stable prices for the benefit of the American people. There you go. And he goes on to say the U.S. economy is in a good place, and we will continue to use our monetary policy tools to help keep it there. The jobs picture continues to be strong, with the unemployment rate near historic lows and with stronger wage gains. Inflation remains near our 2% goal. We continue to expect that the American economy will grow at a solid pace in 2019, although likely slower than the very strong pace of 2018. We believe our current policy stance is appropriate at this time. So there you go. I wasn't making it up that the economy is in a strong place, right? That he continues to see a strong jobs picture. Inflation remains near their 2% goal. So let's have a look at what they call inflation, right? Their measures of inflation. Got here a calendar from last month, or this month, sorry, October. And we've got the latest CPI data. And the Fed looks at the core CPI, right? So that's 2.4% that came out, core CPI. And then you look at the core PCE, which is their favorite measure of inflation. That's at 2.2%. So if anything, do you really think the Fed should be cutting rates if their preferred measure of inflation is above the 2%? I don't think so. So 2.2%. Let's use that one. And now look at the US yield curve. So you've got the 10-year at now 1.76%, and all the way down to the 1 month, they're all below 1.76. They're all below 2.2%. So what that means, if you take the yield on treasuries minus the core PCE, which is what the Fed looks at, real rates are negative. And Jay Powell even admitted that in his press conference. The 30-year is just above positive, as you can see, but it's negative as well if you take the core CPI, which is at 2.4%. So William Martin would have been puzzled that the Federal Reserve is cutting rates while the stock market is at all-time highs. William Martin, even though I'm not saying that I agree with having a central banker that does that. As I said earlier, the best central banker is no central banker. We should allow the market itself to determine interest rates, not a bunch of bureaucrats in Washington, D.C. in the boardroom, right? But he wouldn't have been cutting rates. So why is Powell now cutting rates? Well, I think it's to do with the laws passed by Congress in the early 80s to give goals to the Federal Reserve. And this is what the Federal Reserve acts upon: full employment, right? Stable prices, even though we know these measures of CPI are phony. They don't reflect the real rise in prices that the general public sees. For that, go to shadowstats.com. He shows you how if you calculate CPI as it was calculated in 1990 or in 1980, the rate would be more like 6 and 10% respectively, right? So there you go. He is spiking the punch bowl. So what's going to benefit from that? Well, I expect the stock market to stay still, get a shot of the drug or the punch, right? This is what the Fed does now. The Fed is now not looking after the interest of the general public. They're looking after the interest of the very few who have all their wealth, a lot of wealth in the stock market, Wall Street, right? That's what the Fed is doing. So this should continue to benefit precious metals. The fact that I know we've been talking about negative interest rates like they have in Europe, which is like nominal rates being negative. But right now in the US, we've got negative interest rates, real negative interest rates, right? When the 10-year is paying you 1.76% and the core CPI is at 2.4%, that's a negative real interest rate. And that should continue to help precious metals. It will continue to help the banks because they can borrow for free, basically. They're actually going to be borrowing as well, not just for free, but they're going to get paid to borrow, right? Because the value of that money is going down in real terms. So that's what's going on there. The other thing I noticed when he was asked about raising rates and inflation, that seemed to be the main reason to cut rates, was that he thought inflation was not high enough, even though it's at 2.4%, the core CPI, right, or the core PCE that they look at was 2.2. And someone asked him, what about raising rates? And he seemed to try to distance himself from that, saying, oh, I don't expect inflation to go that much higher. I don't see us having to raise rates. But he also said, of course, that they're going to pause for now, right? But the way the yield curve has reacted to me seems like they're going to keep cutting rates. We've got the 10-year here is down about 8 basis points from yesterday. So what about the questions on the repo market? Did any reporters ask that question? Throughout the press conference or in the beginning of it, a lot of people didn't even mention it. And I even tweeted saying, when are they going to ask about it? And they did eventually. And one thing that I thought was very interesting that Jay Powell said is that they might have to provide intraday liquidity, which is something that I had never heard before. And that's basically helping financial institutions settle their trades intraday. As many of you know, I worked in the financial markets. I worked for brokerage houses, for banks. I can't imagine one of my employers, a brokerage house here in the UK, having to ask the Bank of England to help them settle trades. The Bank of England call the director or CEO and say, what are you talking about? You should have enough money from your clients, and you should be responsible enough to be able to settle your trades. And now the Federal Reserve is actually saying they might provide Wall Street with intraday liquidity, which is outrageous in my opinion. I'm looking more into this. I've read like a paper by a consultancy firm last year, and in it they say that intraday liquidity a decade ago or before the financial crisis was something that was very arcane, very boring, was something to do with the back office and settlements, right? Settling the trades, but it now seems to be becoming a problem. And I think that could be the big problem for the repo market. And what's that telling me? Well, is that telling me that the financial institutions are heavily leveraged and they're acting irresponsibly. I remember back in '07 when the crisis was starting, and I don't have any material or reference for this, but I remember it from, because I was in the markets, hearing about it, right? Or reading something about it to the effect that the New York Fed had to help financial institutions with their daily settlements. There's a lot of problems. The New York Fed had to call loads of people from different banks to meet and sort things out, go through settlements, and it had everything to do with the OTC derivatives, right? So that's what I think is happening here. These banks have gone mad. So nothing's being fixed, in my opinion. I could be wrong. I did write an email to one of the authors of this paper. I'm waiting for a reply, and I will update you on that. So keep that in mind. Intraday liquidity. I thought that was very interesting, and that could be the whole problem of the repo market, in my opinion. So enough with the Fed. So let's see where the markets are this morning. It's just before 8 a.m. We've got spot gold right now at $14.9950, up about $4. We're right near the highs here. The low overnight has been $14.9365. Silver's up 12 at $17.98. High's been $18 and the low $17.78. We saw gold and silver get hit hard yesterday after the Fed cut rates, and after the press conference started. Gold got down to $14.80. Silver got down to, I think, $17.60, or maybe lower, I'm not sure. But then as the press conference went on, the market rallied. So have we seen a bottom now after this press conference, and with the fact and the cut, right? And the fact that almost the whole yield curve now has real negative interest rates, right? We'll have to wait and see. We know these markets are heavily manipulated, right, in the short term. Stock market continues to do well. I think after the close as well, we had good results for Apple. So this morning, the Dow is up another 31, up 0.1%, 27,214. S&P at 30,051, up 4.5. NASDAQ 100 futures up 0.5% at 8122. So yeah, it looks like he spiked the punch bowl. He wants Wall Street to party, right? Very dangerous, I would say. I'm staying out of this party. Anyway, currencies. The pound's up 1/3% this morning, 129.41. The euro is up 0.1% at 111.63. Dollar's down 1/4 against the yen at 108.59. The dollar's down 0.15% versus the yuan at 703.50. Another thing that seems to be up. Another thing that Wall Street seems to be buying into, because I listened to some commentators on Bloomberg yesterday talking about the Fed, and they were saying, yeah, the trade problems have abated. We've gone through phase one, so they're buying into the Trump thing. And so I think that's one of the reasons why the dollar is coming off against the yuan. Oil prices, WTI is up 0.5% at 55.30. Brent is up 0.5% as well at 60.56. Bond markets I spoke about already. The 10-year we dropped about 8 basis points. The whole yield curve is below the core CPI. The whole yield curve except the 30-year, and that's just barely, is below the core PCE, which is a measure that the Fed favors, right? And in spite of that, they cut rates yesterday, right? Mr. Powell, of course, thinks it's the appropriate policy. Well, he wouldn't have cut it if it wasn't, right? Anyway, he spiked the punch bowl, in my opinion. And yeah, be careful if you take some of that punch. It could give you a really bad hangover the next day. If you enjoyed this video, make sure you hit the like button. Subscribe to the channel if you haven't yet. Make sure you hit that little notification bell above as well to be notified of all my new videos. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.